So we're going to work through the Gonzalez depreciation and disposal of asset. So they've got a $60,000 asset with a 6-year life and residual, which is the same thing as salvage value of $6,000, and they're using straight line. And so they sold the asset in the middle of 2017. So we're going to have a half a year of depreciation in 2017, and that's the third year. So we'll have a whole year in 2015, a whole year in 2016, and a half a year in 2017. And when they sold it, they got two assets. They got cash and a note. So the total proceeds is $30,000 split into two different kinds of assets. So let's have a look at this. The activity is operating. The straight line depreciation operating asset. The actual sale is an investing activity, which here they just want to know about depreciation, and depreciation is operating. The accounts involved are depreciation expense and accumulated depreciation, and it's going to go on the income statement and balance sheet because accumulated depreciation is a contra asset on the balance sheet and depreciation expense is on the income statement. So here in your assets, you're going to see accumulated depreciation, negative asset, the minus. And then, of course, you will also see a depreciation expense reducing net income and reducing equity. And then the sale of the assets, selling long-term assets is investing section. And the accounts involved are going to be, you're going to remove the accumulated depreciation, you're going to remove the asset account, you're going to increase cash for what you got, and you also got a note, so you'll also be increasing notes. And then there will be a loss at sale, although we haven't computed that yet. But let's do that. Let's compute that. Let's see how this works. So Gonzalez cost minus salvage, it was $60,000 minus a salvage of, what was the salvage here? $6,000. Okay. So we've got 60,000 minus 6 and 6-year useful life. So for each of the full years, they would get 9,000. And 2017 is half a year, January through July, so just 4,500. And then they sell it for 30,000, of which half is a cash and half is a note. So the original cost was 60,000. And at the time of the sale, you have 2.5 years. You have all of 2015, all of 2016, and half of 2017. So you have the 9,000 twice, and then the 4,500. That is what has accumulated in accumulated depreciation, 2.5 years. So the book value at the date of sale is $37,500, and you got $30,000 for it, the cash and the note. So what you got, the $30,000, was less than the book value, so that's a loss. All right, let's see if there was anything else they asked for you there. And of course, you would record your incoming cash of $15,000, your incoming note of $15,000. You'd remove the $60,000. You'd remove the accumulated depreciation, and you would record your loss on sale here. It would reduce net income and reduce equity. All right. Let me know if you have any questions.